Welcome to the InterMarket Analysis video update. This is a weekly video where I look at a number of different areas in this video. We look at other markets outside of the S&P 500, maybe at other stocks, other indexes, other sectors, just to see if we can get some insight as to what's happening in the S&P 500. I also go through a pretty extensive area of growth versus value. Growth is when you want to buy low and sell high. Value is when the market is becoming more defensive, and these stocks tend to hold up better when the market is declining or maybe going sideways. I also look at the S&P 500 valuation, both on a historical basis and then looking forward. This is being prepared for Monday, July 22nd. I do have a thing called the SPXInvesting Program. If you want to learn more about that, there are links below this video in the description. There are also links available to videos, and there's links that will take you to the actual website. Here's an email address if you want to contact me further about that. I do a number of videos each week. Mostly the weekly videos are around the outside, but for my particular analysis and commentary, they all tie into the daily video. These videos can be interesting and somewhat useful when used independently, but they're designed to all work together with each other. The first area that we'll look at is S&P 500 valuation. This is looking historically at a thing using the trailing 12 months. These are earnings that have already happened, and then comparing them with the current price of the S&P. This comes up with what is called a PE ratio, and when we're at 20 or above, the market is considered to be expensive. That's the red dashed line that you see right here. Price is well above this red dashed line, and to break it out a little bit further, I have the current price in relation to the PE ratio of 20, and we are considered to be expensive on a historical basis right now. But you can see over a period of time that we can stay that way for a long period of time as well. We don't necessarily use this to make decisions. This just gives us an overall idea of where is the valuation level of the S&P 500. We also compare this to different events that have happened going back to 1980 and then where we are at currently. Then there's another thing called the Shiller PE ratio, developed by Robert Shiller. You may know this as CAPE, C-A-P-E. I've also seen this as a PE 10 because he takes a more smoothed approach in this type of PE ratio to try to remove any outliers, to see more general readings with some of these numbers. Well, the current value we're coming in with is 35.5. To get some perspective, here is a historical chart of what's happened going well into the back to the 1800s. And then we can look at this and say, okay, the mean and the median is anywhere between 16 and 17. Well, we're currently at 35. So even looking at the market this way, it's also considered to be expensive right now. But the market doesn't do that. The market looks forward based on earnings projections and forecasts. And that's also compared with the current price of the S&P 500 to get a forward PE ratio. And also on this chart is this purple area, which are the mega cap 8 stocks. These are the darlings that everybody's loving to get into, even though the market's been under pressure lately. Well, as of Friday's session, the mega cap 8 has a forward-looking PE ratio of 31.4. That would be considered very expensive, but these are also very high growth companies, and so people don't mind having such a high PE ratio with these particular stocks. In red is the current value of the S&P 500 coming in at 20.9. Now we're a little bit above that 20 level, so we are still considered to be expensive even when looking forward. Then we have the mid caps and the small caps, which as of Friday's close, the mid caps are coming in at 15.4, right around that fairly price level. And small caps, even though they had a good week, are still coming in under 15 at 14.9. Here's the growth to value area that we look at. First, we look at just a pure growth index. We're looking at growth all by itself, and it's in an uptrend, but has been pulling back as the market has been under pressure. We also look at value, which is also in an uptrend, but it's actually been showing a little bit of strength as growth has been under pressure lately. Where this can become the most useful is when we do ratios between the two. The top part is growth to value, where it's really outperforming even though it has been pulling back. On the bottom is value to growth, where it's been underperforming even though it's been bouncing back up. Now, the reason for these different versions of the same chart is sometimes we can get some insight by looking at an inverted version of another chart. And you can see here where the moving averages actually crossed over each other. There was a little bit of a delay because they're calculated in a different way. And we want to see across multiple different measurements, what are we getting as far as the message? This is the peer growth index, looking at the peer value index and doing a ratio, which even though it's been pulling back, growth has been outperforming value. Here's an inversion of that same chart showing how value has been underperforming growth, even though it has been bouncing back up. Then we look at some ETFs, and we also see where growth is outperforming value, but pulling back. And here it's a little shorter term time horizon showing how value has been underperforming, even though it's bouncing up recently. So we're seeing a lot of confirmation here. Then this is another growth to value index ratio where growth is outperforming, but has been pulling back. We look at a couple of different ETFs, a growth ETF and a value ETF. And the growth ETF has been outperforming, but pulling back in further into the rainbow. Here's an inversion of that same chart showing how value has been underperforming, but recently bouncing back up. Then we break it down a little bit more. Look at the small caps. Well, even though the small caps have been really doing well by looking at the index above, we have been seeing a pullback over the last few sessions. Even when we were going up, the growth to value ratio was going down. That's not necessarily negative, but in a good solid environment, you want to see the index going up and growth outperforming value at the same time. And we're seeing a pretty much similar conclusion or approach using this approach here, where the mid caps have been breaking out, but now pulling back. While they were going up, we saw the growth to value ratio actually going sideways and then declining. Then we look at S&P growth to value and take a ratio of that. When the S&P is really showing some strength, growth will outperform value. Lately, it's been pulling back. We keep an eye on inflation. On top is a monthly chart of the CRB index, and we've been pretty much going sideways overall there. Then we look at an inflation to deflation ratio. When this is going down, that means there's more deflationary or prices are declining, basically. When this chart's really going up, that means inflation or inflationary areas are actually outperforming. We have been bouncing back up recently, but we're still below a declining moving average here. We look at the CRB index, which are commodities, and this is still in an uptrend, even though it's coming all the way back down to its 200-day moving average. We look at the Baltic Dry Index. What does it cost to ship products from one place to another? Typically, when this is going up and in an uptrend like it is now, that tends to be more inflationary. When this is going down, that's more deflationary. Then here's some other markets. These are mainly commodities markets. We look at aluminum, which is in an uptrend, but has been pulling back. We look at corn, which is in a downtrend right now, and wheat, which is also in a downtrend. We look at fertilizer, which over the last 3 months, it started to go up in late spring, even into the early summer a bit, but it's really not shooting up or down all that much right now. We look at oil, which had gone back up into the 80s, but over the last few sessions, it's dropped back down into the high 70s. We look at gas, which is in a downtrend right now. Heating oil, which is also in a downtrend. Natural gas, which is in a downtrend. And we look at diesel, because this is what does it cost 18-wheelers and railroads to be able to ship products around. This has been declining lately, even though it's been bouncing up just a little bit recently. We look at copper. Copper is known as Dr. Copper. It's a barometer of the economy. When this is going up, that means the market is anticipating stronger economic reports and a real growth economically. When this is coming back down, that is anticipating a weaker economy. Well, copper's still in an uptrend, but it has been really declining lately. And so this is suggesting that maybe the market thinks there might be a little bit of weakness looking forward into the economy. We look at a copper to gold ratio. When this is going down, that means copper is underperforming. When this is going up, that means copper is outperforming gold. Well, lately, this has really been falling off as copper's been underperforming gold. This is a longer term look at that same chart. The black area, this is the long-term copper to gold ratio. To give it a little bit more context, we have the 2-year and the 10-year plotted on here as well. We'll look at gold all by itself. Now, this isn't the futures contract. This is the gold ETF, where it is in an uptrend and was really starting to break out, but over the last couple of sessions has really dropped back. Silver also in an uptrend, but has been pulling back recently. And we look at the closing value for gold on top, the closing value for silver on the bottom, and we see that their correlation is not necessarily as strong. It's pretty much neutral right now. You would think that pretty much all the time, gold and silver would move in tandem with each other, and for the most part they do, but we're seeing a little bit of a disconnect with that correlation currently. We look at a gold to silver ratio on top, and that gives us a ratio that we can look at here. When this is going up, that means gold is outperforming. When this is going down, that means silver is outperforming. And then we can plot the US dollar index down in the middle area. And right now, the relationship between the top chart and the middle chart is currently neutral. Here's the US dollar index, a daily chart, still showing that the dollar is in an uptrend, even though it has been seeing some weakness lately. This is the US dollar over 3 years, just showing how we finally were able to break out above this downward sloping trend line. It looked like we were showing a lot of strength, but we've been trailing back off now recently. We look at the euro on top, which has pretty much been going sideways, and then compare that with the US dollar index on the bottom. And these are pretty much mirror images of each other. It's like the mountains on top and the reflection in the lake is on the bottom. Then we do that same kind of thing with the euro and the US dollar, but we also look at the Japanese yen, which has really been in a downtrend. Then we break them out and look at them individually. The euro to the US dollar has been going back up. The moving averages are just trying to cross over back positive, meaning that the euro is slightly outperforming the dollar. The Japanese yen continues to underperform the dollar and has been in a downtrend. And the British pound has been outperforming the US dollar. And we look at some different index ratios. And I show this in the daily video where we have the S&P, which is a weighted index. And so when the bigger companies move up or down, that has more of an impact. The red line is the S&P 500 equal weight, where all stocks are treated the same. And they're moving more or less in tandem with each other currently. And we look at another ratio. We look at the equal weight versus the S&P 500. This is an inverse of the chart we just looked at. When this is going down, that means that the equal weight stocks are underperforming. Well, lately they've been bouncing back up as we've been seeing some weakness in the bigger stocks and a little bit more enthusiasm in the smaller stocks that make up the S&P itself. Then we do a ratio between stocks and commodities showing how stocks are outperforming. Here's an inverse showing how commodities are outperforming or underperforming. And we look at the NASDAQ 100 and the S&P 500, which are coming off of recent all-time highs, but both of these indexes have been under pressure lately. This is coming down because the NASDAQ 100 has been underperforming the S&P in the short term, but longer term, the NASDAQ 100 is outperforming the S&P 500. We look at the NASDAQ and the S&P 500, showing how the NASDAQ has been outperforming, but recently pulling back. The S&P 100, which are the biggest stocks in the S&P 500, the 100 stocks have been outperforming, but recently pulling back as large caps have been under pressure. We look at the NASDAQ 100 and compare it with the NASDAQ itself, and this is showing where we're seeing more strength in the NASDAQ itself as the NASDAQ 100 has been underperforming. Then we look at mega cap, the really big companies, the Magnificent Seven and so forth, and they have been really outperforming the equal weight S&P. But over the last week, we've seen this ratio really coming down. We look at small caps and compare them with the S&P, and even though they've been bouncing up lately, longer term, they still continue to underperform the S&P 500. We also look at that same ratio in red, which has really been declining, but lately it's been bouncing back up. And to give it some context, the blue lines that you see here is the S&P 500. Then we look at stocks and compare it with other stocks. Here's the advanced decline line studies, where we've been seeing some improvement across all of the different indexes that we follow. But over the last few sessions, we have seen the advanced decline lines declining with these different indexes, but they're all still above their moving averages. We look at low volatility stocks. These are stocks that folks like to get into when they're a little bit more concerned about what's happening in the market. And they are in an uptrend and have been in an uptrend for all of 2024. But when you compare it to the S&P, they continue to underperform. The S&P has been actually doing better. We are seeing a bit of a bounce up here, but not enough to really change the direction of this ratio. Here's Dow theory, and traditional Dow theory would be just the Dow on top and the transports, and we like to see a confirmation. Well, the Dow is setting recent all-time highs, but the transports, even though they've been showing some improvement, they have a long ways to go to get back to their all-time highs, and the utilities have been showing some recent strength as well. This is the transports just all by themselves. Even though they were coming back up, they're really not breaking out above these previous highs, let alone the all-time highs set back in late 2021. Then we do a ratio between the Dow and the transports. When this is going up, that means the Dow is outperforming. Lately, we've been chopping around, but not really showing much of a change here. We look at a ratio between the transports and the S&P 500. When this is going down, that means the transports are underperforming, even though lately they've been bouncing up a bit. We look at the FANG index, Facebook, Apple, Amazon, Netflix, Google, NVIDIA is in there somewhere too, coming off of setting recent all-time highs, but now seeing a pullback here, but still above its 50-period moving average. And then if we continue to see more weakness here, I'll be picking out some different support levels that the FANG index may end up finding. Then we look at kind of a new take on Dow theory, where instead of using the Dow, we look at the S&P 500, thinking that's a better representation of the US stock market. And then on the bottom, instead of using transportation, we use the NASDAQ, which is more tech. Well, they were both coming back and confirming each other as they were setting all-time highs, but both have been coming down lately. Then we look at take that same basic idea and break it down even a little further. Instead of using the S&P 500, which is a weighted index, we use the S&P 500 equal weight index, and this finally was coming back and setting a new all-time high. And then instead of using the NASDAQ, we look at the QQQs, which is the NASDAQ 100, and look at an equal weight ETF that way. And this is also coming off of setting recent all-time highs. So these were confirming each other. This had been an area of concern lately, but even though they're both declining right now, the thing that I was picking out was that we were setting new all-time highs with the Q equal weight ETF here, but we were not setting a new high with the S&P equal weight. Well, now that finally happened recently. Then we look at the S&P on top and then the transports and the correlation between the S&P and the transports. And the correlation is actually dropping off now. They're not up into this highly correlated area, which is this red area. We look at the Wilshire 5000, which is a broad market index, setting a recent all-time high, but pulling back over the last few sessions. The biggest software companies in the US, not really breaking out and performing with any real strength, but they are in an uptrend. Robotics and AI, we look at that ETF all by itself, where it has been in an uptrend, but recently pulling back. What's interesting about this is it's been really underperforming when you compare it to the tech sector. Mega cap, these are the big darling stocks that everyone loves. As long as they continue to go up, they are still in a real solid uptrend, even though they've been pulling back recently. This is a total US stock ETF, 2,651 stocks, setting a recent all-time high, but pulling back, but still above its 50-day moving average. The Dow Jones Composite Average, where we take the Dow, the transports, and the utilities and put them together, this has been performing quite well lately, but we're seeing a little bit of recent weakness. ARK, which is a very popular ETF, but it's really been suffering. And at best, it's been going sideways, and it is in a downtrend where we see the shorter term moving average below the longer term moving average. We look at the all world ETF, which takes out US stocks, where they are in an uptrend when you look at them by themselves. But when we compare the SPY, that's US stocks with world stocks, the US stocks continue to outperform. And here's a different way of looking at this with a monthly chart where we look at stocks in Europe, Australia, Asia, and the Far East, and take that ratio showing that US stocks continue to outperform. And on the bottom, we have a momentum oscillator here, the PPO, which continues to be positive. Then we look at bonds, and here is the total bond ETF, which is in an uptrend. This is bonds based on price. The world bond index, which is still in a downtrend. It's been really choppy lately, but it's one of the areas where US bonds seem to be holding up a little bit better when compared to world bonds. Then we look at a monthly chart of stock versus bonds. So it's just showing that stocks are outperforming bonds. This chart is showing how bonds are underperforming stocks. So we're seeing this here on a daily chart. We're also seeing the same thing on a weekly chart. And then back here, we're seeing it on a monthly basis where stocks are outperforming bonds. We look at high yield corporate bonds, also known as junk bonds, have been doing quite well lately. Investment grade bonds, these are more conservative. They also have been doing well, but still have a ways to go to get back to their all-time highs. Then we look at a correlation between stocks and bonds, and this is pretty much neutral right now. When we see a high correlation, that means that the price of stocks and the price of bonds are going in the same direction. When we see a really low correlation, that means they're going in opposite directions of each other. And we look at riskier bonds or junk bonds with more conservative bonds, and we're seeing them kind of trailing off because folks have been willing to get into the riskier bonds or junk bonds because they give a better yield, and folks are willing to assume more risk to get that return. Well, if interest rates are going to start to come down and the market is anticipating the Fed may cut rates in September, we're going to continue to see more of a gravitation of going from riskier bonds over into more conservative bonds because folks want to lock in those longer term yields with safer instruments. And that's why we see this ratio coming down slightly into the rainbow. We look at the 10-year yield and some Fibonacci lines here, and it's really not giving us any insight. Then we look at corporate bonds, which are in an uptrend when you look at the index. And this is another look at the 10-year yield going all the way back to 1980, where we're starting to enter into, since 2022, into a higher interest rate environment. And we look at the 30-year yield and put some Fibonacci retracement lines on here, but not really showing us anything useful right now. Then we look at bonds and compare them with stocks. When this is going down, that means bonds are underperforming. We look at the S&P 500, compare it with the 10-year yield, showing how stocks are outperforming the 10-year. And then we look at junk bonds, which have been doing quite well all by themselves, coming off of setting recent all-time highs. We look at the ETF of the 7 to 10-year Treasury bond, which has been showing some improvement, but it really came down in Friday's session. Then we look at a ratio between junk bonds and government bonds. When this is coming down, that means folks may be getting out of the riskier bonds and getting into more conservative bonds, but still, it hasn't been enough to really change this trend. Here is a daily chart of the yields where, for the most part, they had been declining, but they did come up in Friday's session. We look internationally. This is a weekly chart at rates in the US, UK, Germany, as well as Japan. And we look at the volatility of bonds. That's on top as measured by the MOVE index. We look at the volatility of stocks, which is in the middle area. And we're pretty much neutral right now when you compare volatility with stocks versus bonds. We look at the S&P 500 and compare it with shorter term bonds, showing now how stocks are outperforming bonds, even though it has been pulling back. We look at a broad market measure, the S&P 1500 against those same shorter term bonds, also outperforming, but seeing some recent weakness. We look at another broad market ETF and compare it with further out bonds, 3 to 7 years, also have been outperforming, but seeing some recent weakness. We look at the tech sector and compare it with 3 to 7-year bonds. Tech had been really outperforming, but under some pressure lately. And we look at a monthly chart of the price of the 30-year bond, which has been in a downtrend for quite some time. And then we look at a ratio between the price of bonds and the CRB index, showing that even with the decline, the price of the 30-year bond continues to be in an uptrend. Different sectors, and I just have these listed alphabetically. This is the materials sector, which is above its 50-day moving average. And then down on the bottom, we show a relative strength measurement compared to the S&P. That's the red line. And then we look at a momentum compared to the S&P, where the momentum is looking more positive. We're still negative with the relative strength, but it has been improving lately. And then we compare it on a ratio basis with materials to the S&P, showing how materials are underperforming, but recently have been bouncing back up. Communication. This has been one of the stronger areas of the market. Even though it's been pulling back lately, it's still above its 50-day moving average. We are seeing things a little bit more negative when we look at momentum and relative strength. Then we do a ratio where we've been chopping more or less sideways. As the S&P has been doing well, communication has also been doing well, but we're still in an uptrend, showing that communication, at least on a trending basis, is outperforming the S&P. We look at energy, which finally was able to get above its 50-day moving average. So we're seeing an improvement with the momentum and relative strength to the S&P. And then here's a ratio showing how energy has been underperforming the S&P, even though it's bouncing back up recently. Financials, which have been a stronger area, and that's more positive for the market, even though they're coming down over the last few sessions, but they're still looking pretty solid on a momentum and relative strength basis to the S&P. And they've been underperforming when we do a ratio between the financial sector and the S&P, but it has been bouncing back up lately. And we look at industrials, which are also above their 50-day moving average, looking better here with the momentum and relative strength. But when we compare it to the S&P, really underperforming, but seeing a bit of a bounce back recently. The tech sector, which has been really strong, but is coming back down to its 50-day moving average and seeing some weakness with the relative strength and momentum measurements. Then compared to the S&P 500, tech has been outperforming, but starting to pull back with this ratio. Staples, which are in an uptrend when we look at them all by themselves, but still underperforming when we compare it to the S&P, even though it has been bouncing back up. Real estate, which is seeing a little bit more strength here recently. And when we look at the momentum and relative strength, they are improving, but really underperforming on a longer term basis when compared to the S&P, even though they've been bouncing back up over the last few sessions. Utilities, which has been a stronger area in the market right now, coming back down to its 50-day moving average, and still in a downtrend when compared to the S&P, but it did bounce back up later in the week last week. Healthcare, which is another defensive area, has been in an overall uptrend, but really underperforming when we compare it to the S&P 500, even though it's bounced back up to the 50-day moving average with this ratio. Then we look at the S&P and utilities and take a ratio. When this is going up, typically the S&P is going up. When this is going down, that's usually pressure on the S&P. We have been going up, but over the last few sessions, this ratio has been going down. Discretionary, the things that make life fun, Amazon, Tesla, they're more in this area now. They've been doing well all by themselves, but we're seeing some recent weakness. But when you compare it to the S&P, this has been a disappointing area in 2024, even though they have been bouncing up and showing some improvement since about the middle of June. Semiconductors, a huge part of the tech sector, really showing a lot of strength, but lately been seeing some profit taking, enough to drop below its 50-day moving average. And we look at growth areas and compare them with bonds, showing how growth stocks are outperforming, even though they're showing some recent weakness. We look at a ratio between the energy sector and the tech sector. When this is going down, that means energy is underperforming, even though it has been bouncing back up. And then we look at the tech sector and compare it with the 10-year yield, showing how the tech sector is outperforming. Here's an inverse of that same chart showing how the 10-year yield has been underperforming the tech sector. We look at a ratio between discretionary and staples. Lately, discretionary has been showing some improvement, but pulling back and still in a downtrend with this ratio. Staples have been underperforming discretionary, but recently seeing a golden cross with this ratio, but pulling back and then seeing a little bit of a bounce this past week. We look at a ratio between gold and the S&P 500, showing how gold is not necessarily outperforming the S&P. And how is gold doing compared to the US dollar? It's breaking out above these trend lines and is actually showing a bit of an improvement when compared to the dollar. High leverage loans. This is an area that I've been keeping an eye on. And if we were really worried about the economy falling apart, we would not be barely moving down these days. We're well above the 50-day moving average. So this suggests that things are still okay economically because these are very risky loans. The NYSE composite is still in an uptrend. All stocks continue to be in an uptrend. Emerging markets are also in an uptrend, but not necessarily outperforming US stocks. The Japanese Nikkei, which is setting recent all-time highs, and the microcaps, very small companies, also continue to be in an uptrend. And we look at the home builders, which are really benefiting right now. If interest rates do get cut in September, that would really benefit the home builders ETF. Right now, we're seeing a pretty strong correlation between the S&P and the home builders ETF itself. Bitcoin, which had fallen underneath its 200-day moving average, is bouncing back up and actually been able to get above its 50-day moving average and still in a longer-term uptrend. Then this is internationally using the KST, which is a long-term oscillator. We're starting to turn back up in China. Emerging markets are turning up in Europe, turning back up in Japan, kind of going sideways right now when you look at US stocks. And then we have an intermarket analysis chart where they're kind of all going down together. Red is oil, gold is gold, and the black line are stocks, and then the green line is the US dollar. All of these continue to be positive year to date, where the price of bonds continues to be negative year to date. We look at some correlations between the S&P and the dollar, where they're having a tendency to go in opposite directions. So if the dollar is going up, that's probably pressuring stocks. If the dollar is going down, that could support stocks. We look at another correlation between the S&P and oil, where they're having a slight tendency to go in the same direction currently. The S&P to the 10-year yield, that's coming up into the neutral area currently. We look at the tech sector to the 10-year yield as well, having a slight tendency to go in the same direction right now. And then the S&P to the 2-year yield coming back up into this neutral area. And some long-term charts. This is a monthly chart of the NYSE composite, a broad market index. We're above the moving average and we're still in an uptrend. The Copic curve, which is a momentum oscillator, is also in an uptrend. Here's a daily chart of the NYSE, and we're continuing to be positive here with the NYSE record high percent index. Then we look at a monthly chart of the S&P 500, which is also in an uptrend compared to its moving average, and it's still in an uptrend with the momentum oscillator. And here's a daily chart of the S&P, which is also in an uptrend. And when we do a ratio of stocks to commodities that we looked at earlier, well, this is another way of looking at that, showing how stocks are outperforming commodities. Then here's a monthly chart and another global measure that we use, showing how US stocks are outperforming. The KST is pretty much right on top of its moving average now, so that's not really giving us any kind of an edge. But this is a monthly chart, and it can take a while to update. Then at the very end of this video, I go through and I list what are those things that are positive. And my definition of positive for this video is when the 50-day simple moving average is above the 200-day simple moving average. And we have a pretty long list. When you look at growth and value all by themselves, copper, the British pound, and the euro to the US dollar, gold and silver, the dollar index is in an uptrend. The CRB index, the big software companies, even though they're not really breaking out, they are in an uptrend. The mega caps, the FANG index, the low volatility ETF, staples, as well as the Dow Jones Composite average, and then bonds based on price with everything except the world bond index that we follow. The tech sector, as well as semiconductors, high leverage loans, which is still holding up quite well. The Dow, the NYSE Composite, and Wilshire, those are broad market measures. The NASDAQ and NASDAQ 100, mid caps, small caps, and the micro caps are all in uptrends. All stocks, emerging markets, and Bitcoin. So all of these things are in uptrends. Then we look at what is negative right now, and this is when the 50-day simple moving average is below the 200-day simple moving average. The Japanese yen compared to the dollar, ARK, and then the World Bond Index. So thank you. I hope you found this helpful. Please feel free to check out the other videos. This video, you might find it interesting and somewhat useful, but you really need to see it in context of some of the other videos that I post, specifically the daily videos. So have a great weekend, and I will talk to you in the next video.